In this video, we'll learn to calculate interest expense and premium amortization using the effective interest method. So far, we've learned that bonds can be issued at a premium, discount, or at par. When bonds are issued at a premium or discount, this directly affects the carry value of the bonds, which is calculated as bond payable plus the premium or minus the discount. In today's lesson, we'll learn that the premium or discount gets amortized over the life of the bond, which changes the carry value of the bond each time we record amortization. Just think of it like depreciation. Each time we record depreciation, the carry value of the equipment changes. Each time we amortize the discount or premium, the carry value of the bond changes. Now, to maintain a constant rate of interest, we use the effective interest method to calculate interest expense and amortization. Note, the straight line method is only allowed to amortize the premium or discount when the results are not materially different from the effective interest method. So the effective interest method is your primary method for bonds, unless the prompt says otherwise. Let's see how this all works in action. Start with the question. Prepare the journal entry to record the payment of interest on December 31st, year 1. Make a note on the top of your board. On January 1, year 1, GoldenEye issues $800,000 of 10% bonds. This is a bond problem. Let's start by noting the basic terms. We just read that the face is $800,000 and the stated rate is 10%. Back to the prompt. Interest is payable semi-annually on June 30th and December 31st. The bonds mature in 5 years. The current market for similar bonds is 8%. GoldenEye received $864,884 in proceeds from this issuance. When you're writing out the basic terms and you see semi-annual, bells should go off. I said bells, not emergency alarms. Better. For semi-annual payments, go through the terms and half the interest rates, and if the length of the bonds is in years, double the periods. The 10% stated rate becomes 5%, the 8% market rate becomes 4%, and 5 years becomes 10 semi-annual periods. Let's take a look at our information. Be sure to note the stated and market rates. Here, the stated rate is bigger than the market rate. When that happens, the bonds are issued at a premium, calculated as the amount of the bond proceeds above the bond payable. Here, bond proceeds is $864,884, less bond payable of $800,000 equals $64,884 premium. While we're setting everything out, let's calculate the interest payment. Remember, the formula is just face times the stated rate. And note, the stated rate is only used to calculate the interest payment. Let's plug in our numbers. Face, $800,000 times the stated rate, 5%, equals $40,000. Now that we calculated the interest payment, we throw away the stated rate. As a review, let's do the entry at issuance. Start with the bond payable. We use the face, that nice round $800,000. Liability increasing, that's a credit. Then they give us the bond proceeds, $864,884. Cash coming in, that's a debit. The difference goes to a premium or discount. Here, the proceeds exceed the bond payable, so it's a premium, which is an adjunct account. It's adjunct to the bond payable, so it gets recorded on the same side as the bond payable, credit, $64,884. Now let's make a chart to calculate the interest expense and premium amortization. There are 6 columns. Don't worry, most of them are just rote. Like column 1, date. Column 2, interest payment. Column 3, interest expense. Column 4, premium or discount amortization. Column 5, premium or discount carry value. And the last column, bond carry value. Start the date column with the issuance date, January 1, Y1. Here, interest payments are semi-annual, so put the subsequent dates in 6-month intervals. June 30th, Y1, December 31st, Y1, etc. Let's start with the issuance date, January 1, Y1. For anything that says interest or amortization, we're going to plug in zeros because interest and amortization occur with the passage of time. On the issuance date, no time has passed. Then there's nothing to record yet. Now the last 2 columns. At issuance, we calculated the premium carry value as $64,884. The amount the bond proceeds exceeded the bond payable. Then for the bond carry value, remember the formula. It's just the bond payable plus the premium or minus the discount. Here we have a premium. The bond payable is the face, that nice round number, $800,000, plus the premium, $64,884, equals $864,884. Let's go to June 30th, Y1. First, the interest payment. Remember, this is the only time we use the stated rate for the interest payment. And this is the same payment each time. Just plug it in down the line. June 30th, Y1, $40,000. December 31st, Y1, $40,000. June 30th, Y2, $40,000. You get the picture. Just be careful not to put the payment in on the first line, because on the date of issuance, no time has passed, so there is no interest payment yet. Next, interest expense. Put stars on this column. This is the most important column in the chart. We calculate this by multiplying the bond carry value by the market rate. Remember, we already used the stated rate to calculate the interest payment. That means that everything else is about the market rate. Here the market rate is 4%. We take the previous period's ending bond carry value, 864,884, and multiply by the 4% market rate, which gives us 34,595. Next, the amortization is the difference between the interest payment and the interest expense. Here, that's the difference between 40,000 and 34,595, which equals 5,405. Then the premium carry value is the previous period's carry value, 64,884, minus this period's amortization, 54,005, equals 59,479. Note, we're amortizing the premium. Each period, the premium carry value will get smaller by the amortization amount until it's zero. And lastly, the bond carry value. Remember the formula, bond payable plus the premium or minus the discount. Here the bond payable is 800,000 plus the current premium 59,479 equals 859,479. The bond carry value started at 864,884. As the premium carry value gets amortized down to zero, the bond carry value decreases to the bond payable 800,000. Note, the bond carry value is always trying to get back to face value. When we have a premium, the carry value decreases to the face value. When we have a discount, the carry value increases to the face value. Let's go to December 31st Y1. We have the interest payment, 40,000. Next, interest expense calculated by multiplying the bond carry value by the market rate. Remember, the stated rate only gets used for the interest payment and then we throw it away. The rest is all about the market rate. Here the market rate is 4%. We take the previous period's ending bond carry value, 859,479, times the 4% market rate equals 34,379. Next, the amortization is the difference between the interest payment and the interest expense. That's the difference between 40,000 and 34,379 equals 5,621. Then the premium carry value is the previous period's carry value minus this period's amortization. Here, that's 59,479 minus 5,621 equals 53,858. Note, we're amortizing the premium. Each period, the premium gets smaller by the amount of the amortization until it's zero. And lastly, the bond carry value. Remember the formula. Bond payable plus the premium or minus the discount. Here, our bond payable is 800,000 plus the current premium, 53,858, equals 853,858. The bond carry value started at 864,884. As the premium carry value gets amortized down to zero, the bond carry value decreases to the bond payable, the face, that nice round 800,000. We have all of our December 31st Y1 numbers. Let's do the journal entry. The first column is the interest payment. What's the account when you make a payment? That's cash, and we're paying 40,000. Cash is decreasing, that's a credit. Next, interest expense. This is an expense we're incurring. Expense increasing, that's a debit, 34,379. Next, premium amortization. This is a reduction to the premium. Look at our entry made at issuance. We see that the premium was originally a credit. To reduce it, we debit, 5621. Do our debits equal our credits? Let's add up our debits. 34,379 plus 5621 equals 40,000. We equal. Let's take a step back here and note a few things. When the stated rate is greater than the market rate, the bonds are issued at a premium. Looking at the entry at issuance, we see that a premium means the bond proceeds received are bigger than the bond payable, the face, that nice round number. And looking at the interest payment, we see that a premium means the interest expense is smaller than the interest payment. Just to summarize, when tackling bond questions, be sure to organize your information up front. That makes all the little bond components easier to see. And when calculating the interest expense or premium amortization, just think back to our handy-dandy table. Column 1, date. Column 2, interest payment. Column 3, interest expense. Column 4, premium or discount amortization. Column 5, premium or discount carry value. And lastly, bond carry value, which is calculated as the bond payable plus the premium minus the discount. It seems like a lot, but if you memorize the columns and the calculations, then you will have mastered a large chunk of bonds. For more practice on calculating the interest expense and premium or discount amortization, take a look at the additional videos reviewing questions straight from the AI CPA, the makers of the CPA exam. Next up, we're going to review bond issue costs. You want to be sure to rock these points on the exam. So don't go away. I'm Liz Jo with Test Prep in a Snap.